All right. So what I will do is I will start from where we left because we did not really cover bearish strategies, although they work very similar to bullish strategies. You just go in the other direction. But we'll spend like about 10 to 15 minutes on this, and then I'll go into the session 4, which is the delta neutral strategies. So before that, anybody has any questions or concerns? Happy to answer those. You can again go ahead and paste them in the chat if need to be. So okay, I'll get started. So essentially, last time we did bullish strategies. So what we're going to do is start with two spreads that are, we talked about long put heavily in first 1 or 2 sessions. So I'm not going to go on long put, simply longing a put option. Instead, we will talk about bearish put spread and bearish call spread. How do we use those two to take positions on the bearish side of things? So first of all, the bear put spread, what that is that always you have to see the first word here is bear, which means that it's a bearish strategy, which basically means that you're going to make more money if the stock goes down, as opposed to the bull call spread and bull put spread, which are essentially your bet on stock going up. So the first one is a bear put spread. It's a debit spread because you end up paying something for this to enter into this kind of spread. And why is that? Because you will buy higher strike put and sell a lower strike put. And the best way to see it is, of course, in our model. So we actually see what's going on there. So I have it open, bear put spread, and let's see how it works. So talking about NEO, when obviously I made this spreadsheet, NEO was trading at 28.48. So what you would do is you will buy the higher strike put. So buy 30 put and then sell like 26 or 24 or 25, which is a lower strike put, right? So the higher the strike, the put option is, expensive. So you pay $261 to enter the long put, but then you are selling the 26 put, which you get credit of $60. So your net cost to enter this would be simply the money going out, which is $261, and then you're collecting some credit back, which is $60. So your net cost of entering this is $201, and that's all you will lose. And that's the maximum you can lose. So that's why I call it maximum risk. Now, how does the Pnl work? So the Pnl will actually work. So the best outcome for you is that you want the stock to actually, basically stay somewhere, below the lower strike, right? So, let's do a calculation here, right? So you are 30 strike put long, right? So let's say that it goes to 25, right? What will happen? So if it goes to 25, you make $30 minus the 25, $5 on 100 share exposure. So let me do that, right? So $500 you make, but you do owe to the guy who's holding the 26 put. How much? That'll be 26 minus 25, and then you multiply it by 100 shares. So that will be $100 right there. So in other words, you got $500, but you had to pay $100 for that. So because of that, but then this was not a free bet. You had to pay $201 to enter it. So net P&L would look like you made 500, you lost 100, but you paid $201 to get into this spread. So your maximum gain will be 199, and it will be flat after that. And that's what the P&L will look like, is that if the stocks keep going down, you will still make $199 on this, which is a return of almost 100%, because your maximum risk was $201. And let's see what will be that case. So that case will be if the stock actually, NEO stock, ended above 30. So if it was like 30 point something, guess what? The put that you are holding, the 261 you paid for, expires worthless. And the put that you sold also expires worthless. So you basically entered the spread by giving, $201, and that's all gone. So this is exactly the same way the bull call spread works, but just using the put options, and it's going, you make more money in the stock going down, but your maximum profit will be capped at that. Whereas if you had not sold this put, your potential profit would have kept increasing, and there would not be a flatter line. It will keep going up to like 600, 700 or something. So you are basically, but at the other end, you reduce your cost to enter the trade. Now you're only paying $201, whereas in that case, you would have paid $261. So it's a trade-off there. Yes, you are putting a cap on your profits, but then you are lowering your cost to enter the trade, and that's where that rate of return of 99% comes into play. So this is a strategy you could use if you are bearish on some stock, like say if you are bearish on NEO. But this is using a debit spread, which basically means your initial cash outlay was $201 to enter the trade. But there's another way to do that. But before I jump into that, any questions? I do not see anything on the chat window, so I would, there's one. Hang on. Bear put also requires to have 100. Yes, any stock you trade on, basically because you buy one put option, that means 100 shares exposure you are taking. But it's not a covered call or a protective put, so you're not worried about having stocks in your portfolio. This is a pure option play. So it's not one of those covered strategies where you're holding the stock position and then you are selling or buying options against it. So that's, just wanted to clarify that. So this is straight buying put, selling put, or buying call, selling call, that type of stuff. So I hope I was able to answer it. Okay, moving right on. But this was a debit spread, which basically means that there was money going out of your pocket initially, and you can see the Pnl, like the real Pnl. I looked at, your $201 net position out, and you capped at that 199, and then if the stock moves, against you, you would lose all the 201, and that's what is shown, the risk profile. Let's talk about another bearish way of being on a stock, but using the credit spreads. And why are these credit spreads? Is because you are collecting the money for playing this trade, right? So in here, what you do is you actually use call option, and that's why that middle call, that's what it means, that you're going bearish but using calls, right? And the way you do it is you sell a lower strike call, which is going to be expensive, and buy a higher strike call, C2, to offset it. And the best way is to see through the spreadsheet. So I'm going to take a minute here to go on the bear call spread trade here. Okay, so what is the trade? So the trade is that you're bearish on NEO for whatever reason, right? And what you did was you sold a 29 call, and since you sold it, you actually collect the money of $143, which is what it's doing here, right? But at the same time, remember I told you that brokerage, they don't let you sell naked options, right? You can't just sell it and just forget about it, because in that scenario, the losses could be very high. So you cap it on the top, and you basically buy an offsetting position, which is a higher strike call at 31. And for that, you actually have to pay the $81 for that. So basically, you take that into account. So you collect $62 before this whole thing starts, right? So that's the starting point. Is your brokerage firm will put $62 in your account, but at the same time, they will deduct the maximum loss, because what happens is that the brokerage doesn't, they want to cover themselves to what's potentially the maximum loss that can occur. So let's go through the mechanics of this so we actually understand it, what's going on. So the scenario is, the Pnl calculation is that, first thing is, since you were bearish and something happened and it didn't go bearish and it actually kept rising. So what will happen? Let's say that we take an example that it actually reaches $33, right? Let's say, right? So if NEO stock is $33, right? The call option that you actually sold would be in the money, right? So let's see how much you owe to the guy. So $33 minus the strike that you sold was 29, right? And on 100 shares, right? That's what you owe him, right? The $400. But then you are holding the 31 call as well, right? So you are gonna. So I'm gonna make it negative here. So just to say, this is our we owe that guy this $400, right? And now your call, which was 31 strike, actually is in the money as well, because remember 33 was the strike. I mean, the stock price is 33 minus the strike 31 times 100 shares. So you basically, you have that $200 that you are also going to make in the call that you are holding, which is the buy call, buy side, right? So let me call that as a positive. That's a positive. And remember, you had that $62 credit coming into your account. So I'm gonna make this is a positive for you, really, because you collected that, because you sold that that call option and the spread, right? So basically, your net position would be that you lost 400, but you made the 200 on the call that you were holding, and you also collected the $62 premium. So your loss is actually 138, and that's the maximum you're going to lose, no matter how high it can go. So that's why it's a bearish. It's the maximum risk you are taking is 168 and in the 138, because that's what and you can see down below is that if the stock price actually really went even to 100, you would still have lost the 138, which is visible here. On the gain side, let's say the stock actually behaved well for you, and it behaved well for you, and it actually fell below the strike you're holding, which is 31. So if it is below 31, you sold 29, and you're holding 31. So if actually it falls below 29, both call options expire worthless, and you get to keep the $62 credit, and that's what is maximum gain you're going to get. Now, what is the advantage and disadvantage of this type of approach? Obviously, the ROI is not good, 45%. So basically you're counting on a bet that I'll make $62 by an investment of 138. So I mean, it doesn't look too promising, but the good thing of that is that if new stock holds itself to 28.48, you are the winner. So remember, I was telling that a stock can behave in three ways. It can go up, it can go down, or it can stay sideways, right? So in this kind of credit spread, you have two scenarios in your hand, and those are it stays sideways or actually goes up. In both those cases, you make money, but the only point where you will not make money is if it just basically it kept going up, and that's where you will lose that 138. So that's just about the same logic as we had in for the two call spreads that we did bull call spread and the bull put spread. So bear put and bear call are just bearish in nature, but it's the mechanics works the same. I hope so. Does that make sense? Any other comments or questions or anything before we move on? Okay. So, that wraps up the session 3 where we actually did, and then this is a Pnl. You could see the same thing that I did with the 62, and this is just a plot. But basically, we covered the spreads, the bullish and bearish strategies, how you use combination of call options and put options to establish your viewpoint. The most important thing you have to note is that a credit spread is when you actually collect the credit initially, and the brokerage will just hold against you the $138 from your account, because they don't want to. What if the stock actually moved and you take the 138 loss? So brokerage will deduct 138 from your account to enter this trade. So from that perspective, you collect the 62. If it behaves well for you and if the stock price actually went south like the bearish, you would get to keep that 62. So those are the credit spreads where you actually sell something versus the debit spread is pretty much similar to a long call and long put, but you hold an offsetting position just to curtail your your exposure, so that you're not exposed to heavy losses and your ROI is maximized. So that's the whole idea behind those. All right, so I will jump on to session 4, okay, now what we're going to do is something very exciting, and that's the neutral strategies, how we can actually play it when we don't know really what the stock price is going to do. right? There are different scenarios where you don't know if it's going to go up, if it's going to go down, if it's going to stay there, or if it's going to actually move big time, like huge move in one direction, but you don't know. So like the earnings play, right? When earnings come, generally they move 5 to 10%, some 20%, whatever, right? But you don't know if, it could go. So let's say this week, let's say Apple's earnings are coming, right? We know that's probably going to move like 5% or something, but we don't know if it's going to go up or down, right? So what do you do in those type of situations? So that's where we call neutral strategies. Means that directionally you're not too sure, and that's why you want to stay neutral and play it. So how you do that? That's the next topic. So this is about the same thing that I said. You don't know if it's going to fall or rise, but that you want to still play it. So first thing is long straddle, and this is a very interesting strategy. A lot of people employ it before earnings, because what happens is that you don't know if it's going to go really up or down, but you know it's going to move. That's the bet you're playing. Now, a lot of times earnings, you don't see the stock move, so that's when you're going to lose. And that little V dip is when, if the stock stayed around A plus and minus a little bit, then you are in the loss zone. But if like Apple moved like against all odds like 10% plus and minus, then you will make money. And we'll look at the mechanics of how that works. But let's look at long straddle. Actually, let me go to yeah. So let me show you the mechanics. So how does it work, right? So a long straddle is when you basically take same expiry. That's very key, right? So let's talk about our favorite stock, NIO, right? We're going to say that NIO's earnings are in that week, the week before November 13th. I think it's 11th November or something. It's okay, whatever. But I think it's before that. So I picked that accordingly. So basically, what you do is you take a position, same strike. So the expiry stays the same, 13th November, and I believe it's 11th November. And I want to see, I think NIO is going to either make a huge upward move or it's going to make a huge downward move. It's not going to hold itself around 27. It's either be 35 or it's going to be 20 back to 20. That's the bet I'm playing. So how do you play that? You'll say, look, I can buy a call of 27 and a put of 27, right? So let's play the, let's go to the calculation, right? So the long call on NIO for 37 strike expiring on 13th November is $235. Let's put that. 235 money out of your pocket to get that call option. And then there's a put option. You also bought that 27 strike, and NIO stock is today 27.16. So that's 205 out of your pocket. So total cost to enter the trade is actually it's a lot of money to give in. So it's about $440. But now, what is the beauty of this is you holding NIO for about 3 weeks through the earnings and placing a bet at 440. So now, anything can happen, right, in stock market. So let's say NIO stock actually earning, first of all, there are 3 weeks in there, right? And then there's an earning play in there, and then NIO can have some couple of news coming in, whatever, right? So we have an exposure of about 3 weeks from here, right? And how will the Pnl look like? So if NIO stock actually is back to 20, right? Let's calculate our Pnl there, right? So on the 20, let's say stock price is 20. The put option is obviously going to be making you money. The call will expire worthless. The 27 call does not make you money, right? It's gone. So how much money the put will make? So the put will make 27 minus the 20, because we thought that it's gonna perform bad and it's gonna be back at 20 times 100 shares, right? So that's the PL, the profit, the 700. But you entered at 440. So the net position or net profit that you have is 700. You collected, but you had paid 440 to enter the trade. So your position is 260. So your P&L will show 260, and that's when stock hits 20. So that's how that 260 came. So see how the more it drops, like if it's 15, you see that at 15, obviously you would make a lot of. So if you put 15, the stock actually hit $15 back. It crashed, right? So then you make on that put really delivered for you, because you paid only $2 for it, or $205, and it ended up in $1,400. So that's nice, right? And then obviously you had to pay because call you ended worthless. So that's your cost, because that is also your holding, and it expired worthless. So that 440 needs to be subtracted from 1200, and that's how you get the 760. But still a great ROI, because 760 divided by the cost to enter the trade is 172% money you made on that. On the other side, like same thing on the positive side, like if it hits $40, right? Same thing. Put expires worthless the 205, right? Because it expired above 27 strike. So then it'll be 40 minus the 27. The call really delivered for you this time. 100 shares, $1,300, and then you subtract the 440 that you paid for it, and that's how you make 860 and a very nice return, almost 200% on that. So the idea is these straddles, you are counting on the stock to really move. Now, the worst case scenario would be what? Stock really did not do anything in like next 3 weeks, which is unlikely because there's going to be earnings and all that. But your worst loss will be 440, because guess what? Your you basically pretty much everything expired worthless, like the call and the put both expired. But it's a very rare chance that it will actually just literally expire at $27 this year. It will be really unlucky that happened, because you are actually right at the bottom of this, that you lost everything. Generally doesn't happen. I mean, even if you lose, you're probably going to be breaking even. And now what is the break even? So the break even is that on the upside. So basically, if the stock moves above 31.40, you're okay, because guess what? It will cover the 440. So let's see how that works. So the 31.40. So the stock actually ended at 31.40 minus the 27 strike, right? Call put is worthless, right? So 440, yes. So you made the $440 back. So upside, yes, you needed to hit at least 31.40 on that earnings date. The expiry date, 13th November. Or on the downside, if it keeps dropping, then really go down. 22.60. Then after that you start making money. So that's how this actually works, is that you have to set your upside and downside break even, and then look at the range. Do you really think from this price of 27.16, you have a range of plus minus $8 with the earnings in there? Maybe not. I don't know. I'm not a fan of straddles, but I, things. Now, one thing I want to tell you though is market is very smart. Those people who are pricing those stocks and the options, they're very smart people. What they'll do is they'll jack up the prices before the earnings. So if straddle, so if I go to straddle and if I buy a straddle of 27, now for this week expiry, there's no big news coming. So they're giving you for that $2. So basically 27 plus 2, you are break even. 27 minus 2, you'll probably break even, right? But then let's see what happens on 6th November. So that was $2, and then 27 here was 350. But watch, the 13th one will be. So the 13th one is actually 440, somewhere in the middle, right? So they will, and these will actually rise. Right now 87% volatility. The volatility here is 85. Actually, it's a good trade now that I see, because and that's the next week. It's calendar spreads. I'll talk about that. Like there's a spread gradient there. They didn't price the earnings big time here. I was hoping this would be more than 120%, and eventually it will happen. They will keep raising this volatility as long as because when you'll buy towards the, so this will not lose its value. Why? Because people know that it's going to be an earnings play. Just up till before the earnings, it will hold its value, because remember, one day before the earnings, it still can move plus minus $4. So and that opens up a huge discussion of calendar spreads, which I don't want to go right now, but next week, hopefully. Yeah. So that 87% implied volatility versus that 86% is actually a good play here. And then let's see what was this here. And then 70, yes, 72%. Yeah. So yes, the volatility will rise, and that's why I want you to think about implied volatility when you're placing these trades. But we'll come back to that later. So that was the long straddle trade. Now you can actually sell that long straddle and call it short straddle, but brokerage will not allow you to do. And we'll talk about butterflies in a minute here. But I'll come back to this and relate it to butterflies. What does that matter? But let me see. Is there any? Thanks, very good. Okay, thank you. Yeah. So, but we'll talk about this when calendars come, because those are my favorite. So I always think about calendars because those are much more. That's the way I think. But we will come back to that. Let's go back to our next strategy, which is the which is the let me see. It's the Condor. It's a Condor. But before, let's talk about Strangle first, okay? Because that's another important.
Sir, I have a question regarding the straddle that we're talking about. So you recommend buying a straddle like a month before earnings?
You can do any time. You can buy a straddle 2 years out, even today. You want me to show you here? So 30th October, so we can do it. We want a straddle of January 23rd, actually 3 years, almost 3 years, 817 days, 27 straddle. What is the price? See, that's a huge price because they know that either actually here, this is very strange because they're actually charging you a lot for a 3-year straddle because they know it's either $100 stock or yeah. So in this scenario, this is very expensive actually. But 27 straddle 3 years out or 2.5 years out is like $2,500 right now because essentially they're saying that it's going to double. Well,
right.
Yeah. So but this is too extreme a case. You wanted to know if you want to, let's say, hold it till January. So that 27 straddle this is also expensive. I think that's 92% volatility. So 950, about 950 for January. See, but there may be 2 earnings falling in there, so they are pricing it accordingly. But 20th November 27 straddle is 5. So, but I really like the way you are thinking now because that's going to lead you into becoming truly an expert in how the options play. But you have to think like this: that okay, well, what I'm paying, generally people just click and buy something that is very pricey or that is very. Let's look at Apple. Apple is coming with earning right this week, right? So Apple straddle. Now one more thing I want to teach you is very, very important. How do you know there's actually even those who don't do options actually find out the potential move in Apple stock? And I'll tell you a technique how to do that. So anybody has any idea about Apple? Do you think it's going to move plus minus 5%, plus minus 3%, plus minus 10%? We don't know yet, right? But there's a way to find out, right? What market thinks. So go to 30th October. I think Apple is announcing on Thursday, right? So at the money strike, 115 strike is the straddle is actually almost 690, right? So right here, you can actually see how much they're pricing. So 690 for an at the money strike would be 690 divided by 6.90 divided by what is the price of that Apple is 115, right? So it'll be 115. Yeah, about 6%. Yeah, they think that Apple is going to move 6%. That's how, because otherwise they would not be offering you that price. Market thinks Apple is going to move plus minus 6%, right? At looking at this, because always use at the money strike straddle percentage move as your indicator of what Apple is truly gonna, because these markets they're because otherwise you will sell that straddle to somebody else. So they want to price it so that it's very close to what it should be, right? So that's why they are pricing like let's look at Amazon. Amazon is announcing, right? Is it 3,200? So let's see, 3,200 strike for weekly. So this is 221, 220, so about 223 divided by 3,200.
Yeah, I think Amazon is on 29th.
Yes, so it is announcing. So let's see, Amazon probably more percentage. 223 divided by what is the stock price? 3,200 something. 3,200, right? So Amazon is probably priced at about 7% move in Amazon. When you look at stocks that are volatile, this could be 10%, 12% easily because market knows. Well, I don't want to say knows because sometimes market is pricing 5% and it moves 20%. But generally, market indicates you, and that's a very, very widely used technique to find expected move in a certain stock at earnings is using straddles. At the money weekly straddle price as a percentage of stock price. That tells you it's going to be 6%, 7%, or what. So if you really want to play on a volatile stock and really I mean, you can play with it. I mean, do you have any other stock that is, I mean, Microsoft also is like, see, these all are similar. They're going to be about 6 and 7%. So I think we can move on. I mean, you got the point, right? So let's look at strangle. Now, strangles are in when, you know, you basically what happens is that you establish a little bias. You still are not sure if it's going to go up or it's going to go down, but you have a little more bias that it's more likely that it will go up, but I want to have a protection on the downside. How does that work? Sorry, somebody's trying to, let me get them in.
I added him. Steve wanted to join.
Oh, okay. Thank you. Okay. All right. So we learned something today, right? So now we're going to talk about strangle. Strangles are actually better than straddles, in my opinion, because you take a little bias on some direction. Let's talk about NEO, and we'll do a quick example, and we'll come back to this. So on NEO stock, right? This is a long strangle, right?
As well, if you look at the question.
Oh, sorry. Yeah. Yeah. Okay. In option change to the top right, we have expected move. How much effective is that? You know, they build this is something that the brokerage companies actually have algorithms that they will build, and potentially will move this much, that much. I mean, you could trust on it. I personally haven't used that too often. I mean, you can calculate it. You can, I mean, try it. It's just sometimes they're right, sometimes they're wrong. I mean, generally I don't trust that too often. So I don't have experience in that. I don't want to bias you on something. I mean, maybe Interactive Broker has a better algorithm, or TD Ameritrade has a different. I mean, Tradier has a different. So this also depends on how they are actually coming up with those probabilities. So yeah, so I don't want to endorse that at this point. And it's more of a question of stock price movement, which you can trust the brokerage recommendations, but generally it's really up to your intuition and your analyst, or how you see the stock move. So let's go back to NEO and do a strangle here and see how that works. So a strangle is like literally buying, like taking a bias. So NEO's 27.16 on earnings. You know what? It's a high flying stock. I am more long on it than I'm short on it, right? So I'm going to take 27 call, which is 235, right? We all know that. And then I have to pay the put also. But it can drop big time. It can actually go to 20 or something, right? But I'm going to take 25 or even 23 maybe, and just pay 121 instead of that straddle, so this is 356 price. That one was 440. So I'm gonna skew it a little bit, right? Just because I'm more bullish on one side, so I want to take a position like that. So that's why my cost now is 356. But then the gains are going to be calculated accordingly. So now, first case is that you are actually right, and NEO, kept rallying and actually went to like 40. 40 minus 27 is your gain on the long call. Multiply it by 100. That's 1300. And then of course you have to pay that 356, right? So that's the net 944 out of, that's a huge return, right? You made 944 on an investment of 350, almost 2.5, yeah, 265% return right there, right? So if you're correct, that's what's going to happen, right? If you are wrong and it kept tanking, but then see, the Pnl is interesting, right? So you will start losing until at a point like that put option now is starting to really save you. Sorry, I went the other way. Yeah, this way. So you will lose more. So let's do a couple of cases here, right? So let's say it went to 2, I'll just make it like 24. Like if it goes to 24, guess what? That call which you had a lot of bet on didn't deliver for you, right? But that put is probably going to hopefully save you some. So that will be 25 minus, we said 24, right? So that's about 100. So you did collect. I mean, both were not worthless. I mean, you did collect, $100, and you paid 356. So your loss is actually, you were able to make some out of it. So 256 would be the loss if the stock was 24, right? But hey, if it goes to really, sometimes those put options do save you. I mean, that 15, if it goes to 15, then you say that, the one that I was not hopeful, but guess what? It delivered for me. And then you would say that put option is actually stock is now 50, NEO really disappointed, right? So it went from 25 to, 15. So you will make that $1,000 on it, right? Because that put delivered for you, but you subtract the cost of the trade, which was 356, and you still have 644, and it's a nice return, 200, almost 200 or 150% return on that. So yes, straddles. Straddles are more neutral, truly delta neutral. But these triangles are a little bit biased, skewed one way or the other, or maybe buy a put option that is deep in the money. But worst case, if it goes up, then you have a call option that will protect you in case you are wrong. So that's the idea behind having strangles. Now in strangles, the one thing is that between 27 and 25, you will lose everything. And that's the bad part. That's the maximum. Like, you are truly unlucky that 3 weeks you waited for it, and this thing just halted there. And today, on expiry, it's at $26. Guess what? That 27 call didn't deliver for you. That 25 put didn't deliver for you. Lost completely. $356 gone. So that's 100% loss. But I generally think it probably won't happen. Where's the break even? So the break even upside is 30.56. Right? No. Yeah, upside is 30.56 because that call will start delivering for you, after that. But on the downside, it's 21.44. So if you're okay with taking a range of risk of 9.12 plus and minus, play this triangle. But I would personally not do it because those I'm not too fan of, because they can deliver for you, but generally they don't. And I will talk about that in week 5, that why I think they don't. They can, but they are generally what market is trying to sell you. I am of a great believer, you sell that back to the market and you say, you take the strangle or straddle and I'll watch you if you make money or not. Because otherwise, if they are offering you, it's a conversation for week 5. But a lot of people use straddles and strangles. The key here is that before earnings, any option you're holding that expires after the earnings, watch out for that price, because they will jack up those prices as you see. Right now, we didn't see that big of a difference in NEO, but guess what? That last week when everybody really wants to just supply and demand that also, because everybody wants to hold those options, it's going to move to $50. So that supply and demand also makes that pricing high, and also the volatility. There's just more volatility expected. So just watch out for those things. Any questions before I move to butterflies? Okay. All right. I think we're good. All right. So we will.
So you don't recommend using straddles and strangles?
See, it's a statement I should not have made. It's a personal preference. If you play aggressively, I would, let me put it this way. There is a reason why I say that, and that reason is your time decay is going to keep hurting you, because you are holding a call and a put, and you are literally looking for it to move. And if it's not moving, it's more frustration for you because it didn't move. And then another reason why I think that if you really want to play options, you can take a side of it. You can try to make that big win, and it's expensive. Like, if you go here straddle, $440 for a move, and plus a range of $8.80. Now, you see, nobody can say that it can actually move to 50. Like we saw that in the second session, that it actually moved from 21 to 28. So what leads me to think maybe on NEO I'll go long, but I don't know. It can actually be at 35, and then if you're holding it for 3 weeks, God knows, it could be $50, or even my curve is not capturing it. It could be like, think about $50 move. Like if it is 50, literally $50 after earnings, it just kept breaking out and out and out. But you have a put option that hedges you. That's a lot of money you make, 1860 out of a 440 investment. But I think strangles are better, just because, if I am bullish on something, I will protect a deep out of the money put option like 25 or 23 even, and give myself chance on that 27. So if you look at, if I had made that 25 to 23, my cost would even go down. 23 NEO put of 30th. See, this is single, and then the put option on 2023 put is going to be really cheap, just $60 and protect yourself for a very adverse move. I selected 25, so that was 121, and that's why that number is there. But you could select like anything. It depends on how you play, how you want to play it, right? But the reason why I said that I don't like them is because time is working against you and double pace. The call has extrinsic value and the put has extrinsic value. So let's look at that. So see, right now on a 27 strike, guess what? Only 27.16 minus the 27. So you are really paying $16.16 out of that 235 is intrinsic and everything else is for time. So the time value of that would be 2.35 minus that number. So that's a lot of decay in 3 weeks. And now same, and then I'll look at the put option. It's actually out of the money. So there's going to be a lot of decay. So that 121 is all extrinsic value of just because of the time for 3 weeks. So that's why you're losing on call and put both in terms of time. So that's why I generally don't like it. I would rather use that time to my advantage, and that's the topic of week 5. We'll talk about calendars and selling options and how we can play these. I mean, you can always go bullish and bearish just by not giving this time value of money. But see, then that comes back to leverage. You are holding a very nice position just for $440 for 3 weeks in which an earning falls. So you can, otherwise, if you want to play it, this is a $2,700 stock. So, I mean, $2,700 for 100 shares of that stock. So, I'm just trying to give you intuition of how these things work. All right. Anything else before we dive into butterflies?
Thanks, sir.
Okay. Second here. Everything is good. Okay. So now the butterflies are very interesting. So basically what is happening is that, look at this butterfly. This is actually, there's a range in which you make money, which is pretty much between, if the newer stock, I gotta show you before what's happening in a butterfly. Hedge Straddle and hedge. So those are actually important too. But allow me a couple of minutes to talk about Hedge Straddle and Hedge Triangle. So those are actually extremely important, and I do them actually, and it will answer some of the questions that you posted before. So that time decay does hurt us, right? We all know that hurts us. And what you could do is actually, and I'm not going to go in deep detail of how hedge straddles work, but generally the concept is this: you buy 2 contracts of a straddle. So near long 27, near so going 27 call and 27 put, like I showed you, but buy 2 contracts, both two here, and then sell one out of the money call and one out of the money put. Now, what will happen? This will actually save you from the time decay. And now these that you sell are actually weekly. They are 30th October. So those, if we had time, we could go through the mechanics. But so what those will do intuitively is that those weekly calls, remember, they're very expensive and there's a huge time decay there. And you're only doing it on one contract. Now, what will that do is, if the stock really moved up high, you will still make money on the calls that you're holding, the 2 calls, right? If it falls brutally down, the puts will make money for you. But if it stands there, those 2 that you sold, the 29 and 25, will make up for some of that time decay that otherwise you would have seen. So that's the whole concept, is that you sell an out of the money call and an out of the money put weekly. Not the same expiry, that 30 November, if you had done that, because those will not decay as fast as the one at 30th October. So those will, so how much is that price? Let's look at that. 30, 29 call, 25 put. So 30, 29 call would be, you are selling them, remember. So 29 call. So you make 45 plus 30, about $75 in 1 week. If it doesn't move, that's the money back in your pocket. Because it stayed at 27, you sold a 29 call and a 25 put. Hey, but that's $75 back in your pocket. So your cost now is actually going to go down by that much amount. And then you do the same the following week. So two iterations, and you make $150 or $200 back from there. But of course, the challenge in there is that you're limiting your upside. Like if NEO goes to 35 before even the earnings is there, don't do it in the last week, because in the last week you are counting on those earnings. So do it once that is expiring 30th, and then on 7th or 6th. But don't do it in the last one, because you want to play on the earnings. So do it 2 times. The downside obviously is that if it runs pre-earning like up to 35, 40, then you regret yourself. I should not have sold that call option. But it goes both ways. So that's an important concept that people use a lot, is hedge straddle. And if you have that straddle for like, instead of 13th November, like maybe about 45 or 50 days out, like December first week, then you could do those iterations like 3 or 4 times and lower overall cost of ownership. So that's the intuition behind that. So those are called hedge straddles, because you're putting a couple of hedges around them. And then same thing for the hedge triangle, also about the same, but here also you do the same sell weekly calls and puts against your holdings that you have a bet on 13 November earnings play, and do it in 2-to-1 ratio, 3-to-1 ratio. Like if you're holding 3 calls and 3 puts, maybe you do one, just sell 1 against them. So that way, so it's 3-to-1 ratio or 3-to-2 ratio, or 2-to-1 ratio. But that's something on you, how you want to play. So, all right, moving to butterflies. So the butterfly is actually very interesting strategy, which actually what it does is that it will deliver for you if the stock price did not move. Like you see that the profit zone is tight zone, which is break even left and right. So how does the mechanics work? Let's go there first, because without that it will not make sense. Okay, so the way it works is sell 2 at the money call options, right? So these 2, which is called body. So a butterfly has a body and the 2 wings, left side wing and the right side wing. So that body here is so you sold 27 strike 2 call options. And then how much credit you picked up from there would be 2 times 100 shares on each times 188. So that's because you sold those 2. So this is money in your pocket, right? Now you have a resistance call, because what happens if it starts falling down, you have to have a little hedge there. So that's why that 25 call you basically buy, and the price for that is 298. This is a little tricky, but it'll be fine in a minute here, okay? And there's a resistance wing, which is the upward. So so you sold 227 calls, but bought one which is higher strike, 29, call it resistance strike, and then a support strike, which is 25. So look at this important. Support wing call strike buy 25, and that's going to be very expensive call because it's deep in the money. So that's why it's $298. And then the resistance wing, which is at higher resistance, 29, because otherwise what will happen is that if you keep going up, you lose on 2, you one of them will cover you, the 20. So let's say I don't do this, I only leave it there. First of all, brokerage will not let you do it, but let's say it lets you do it. So you sold 2 call options. So if it goes to like $50, right, then the problem is this. If the stock price is $50, then this is a problem. 50 minus, you sold 2 call options that were at the money, so 27, and 2 of them. So yeah, $4,600 right there, right? But you need to be protected on, so the one that you owed, this 25, would actually be, so it'll be 50 minus 25 times, and you only did 1 of those, so that'll be 100. So yes, you are still gonna be losing. This is your gain, and then you're losing this much because you sold those. So that's a lot of money. So that's why you have to have a resistance call, which will start protecting you after 29. So you don't want to take a loss of going up to 50. So after 29, the second call will kick in, right? And that's why you have call it the resistance call strike. Now, what is the mechanics of this whole thing, right? So the mechanics of this whole thing is that what will happen, the best case scenario is if it stays at 27, right, then that's a really good outcome for you. Why? Because at 27, right, all that time value you capture, all that you sold that, right? So 2 contracts, 100 shares times the 188. we got to keep that 375 because it, guess what, on 27, let's say it's expired, let's say it's like the price, stock price was 26.99, let's say, right? What will happen is that, yeah, whatever, 27, that's fine. 375, because guess what, you don't owe anything on $27 strike because it just was at the money, right? You get to keep all the credit, 375, right? Now you do have 200 because of that call option of 27. You have that 27 minus 25 times the 100 shares, right? You keep that to 200, but then that third one is worthless because remember it stalled at 27, so that 29 which you bought is gonna get worthless, right? So this is your maximum possible gain that you can get is 575. But you have to the cost of this is gonna be, you know, $32. So let's take a look at this. So at 27, see what happened. Something's wrong. So you have two contracts, 100 at. I not subtract. So okay, this is all credit you have to keep. Oh yes, you didn't. So I didn't. There's a cost to enter, right? So the cost to enter is this. Let me do that. So what is the cost to enter those two? So there was a cost to enter 298 plus the cost to. So let's take that times 100. We'll come back to it if it's not clear to you. Let's redo it. I think I went too fast there. Okay. So first of all, what is the cost? Let's calculate the cost here, right? So the cost to enter this trade is 298 to buy that lower call to 25. That's out of your pocket. You're buying it, and then you are also buying this third one, which is 109 times 100. These are the two you bought, right? 407, but you sold two, which were 188. So it'll be 2 times 188. So net cost to enter the trade would be bought minus sold, $31 or $32, whatever that is, right? So $32 you entered, and the maximum reward is that little tipping point right there. And why is that? Because remember, those two were expired worthless. Actually, three options expired worthless. The ones that were 27 strike, those three expired worthless, and the 29 expired worthless. But that 25 you were holding, actually you made 25, and because stock price is 27 minus 25, right? So $200 on that. So 2 times the 100 shares. I didn't. Right? So 200, but then your cost to enter trade was 32, 31 or 32, whatever that is, and it will be. So that's the maximum gain you get is 168. So the ROI, the maximum ROI is 525%. But guess what? It's very, very, very unlikely that it's going to stall that much for 5 weeks, for 3 weeks here, right? But the bottom line is here you are making money if it stalls and it doesn't move too much. What is the break even? So the break even is if it stays between 25.32 and 28.68 for next, 3 weeks or so, then it's a profitable trade because you are actually in that triangle somewhere in there, either here or here or here, whatever that is. But you are green. You will make money. Maybe not 168, but you'll make some money depending on where it ended, right? A better strategy than that is Condor, and Condor is because this is misleading. Why? Because you are getting 525% return, but only at a tipping point when it's right there, a little bit below or little bit to the right, your losses start, not losses, but your profit is not as strong. So this ROI is maximum reward over maximum risk. So generally you take an average of this. So you're still looking at if it stalls, I generally take an average and I say, it's not gonna end up right here. But if you look at the area of a triangle, I just half it. So it'll be like, 525 divided by 2, about, 200+% gain if it stalls somewhere in this range here, right? So this is called butterfly spread. You could do that same thing with put options, but it's the same thing. It's called butterfly call spread. But if you do the put spread, it's going to look like the same. I don't know if I did a good job there, but was it somewhat clear, or should I go one more time on the Pnl or? It's basically selling 2 at the money calls, buying 1 deep in the money, and one selling and buying 1 deep out of the money. So you make those 2 wings. Those 2 wings are right here, are those wings. So that 25 is starting your first wing, which is that right here. 25, let me color code it. That 25 is that here. And then that 29 is the one that is resistance one, is right here. But since you are buying 2, you sell 2 too. And those the 2 that you sell are actually right in the middle ones, and that's where this is the butterfly, the body of the butterfly, where you're right in the middle of that. So that's why it's called a butterfly. It looks like a butterfly. So this is, but I like Condor more, and let's look at the Condor in a. So I gotta change that. It's a Condor. So in a Condor, what happens is it's a similar concept, but you hold some gains here. Like I said, you don't want to be at a tipping point where you're saying, 525% gain, but that's very misleading, because it will happen only if it is precisely at 27, right? That won't happen. So generally, you define a Condor, an area of so you say that between 26 and 28, I am the winner, complete winner, like the maximum gain profit of 207%. And then otherwise it's the same. So basically you do 4. So let's color code them. So lowest, which is you buy the deep in the money, so 24, let's color code it, and let's call it yellow, and that's right here. Okay, good. And then there is one limit, which is 26. So between the 2 limits, the 27 and 26 and 28, I need to get my maximum gain, because I truly believe this is going to really stall at 27 and it's not going to go anywhere. So that's where I define myself as the profit zone for me. But then I need to cover myself. So that 30 is where I feel that after that, it goes. So now the advantage of this is, what is your maximum loss? Your maximum loss is, as you can see, is actually $65, right? But in the Condor, right in middle of right here, you can make 135. So then this calculation makes a lot more sense, that your maximum risk and reward ratio is now about 207%, and you are about gonna be in between 26 and 28, hopefully. But some people play it if they think that it's only $65 I'm putting to try to making it, $135 out of a $65 investment. So it's about twice. You could do that, but with an earning falling, I don't know. But that's a Condor. It's really the same as butterfly, but you chop it off and you call it that this is the range I want to. If it stalls between 26 and 28, then I make that 135. And if it starts dropping, I have a wing built quickly here. So my resistance and my support, those will come into play, and I will not lose the money. My eyes capped at $65, so you can play that little trick there. If you ask me, they are good. You could do them, but there's a time component which is very, very important, and that's next week when I talk about calendars. My problem with this is that this is all expiring in the same day, and I would rather sell ones that are weekly and hold ones that are monthly, or 2 or 3 months out. That way, I am truly enjoying that decay in time. So that's where the calendars come in, and you actually spread the expiry in those calendars, and that's where you can gain this one is like a bet, as a naked call and naked put is. So I think those are more sort of directional. Here, only the direction you're choosing is a neutral direction, versus in those other spreads, like here you are choosing one side. So it's either a bearish call spread, bearish position, or a bullish spread. So that's the difference between the neutral strategies and directional strategies like that. But I think we will talk more about these. We're coming to the top of the hour. But let me see if I missed anything. So we talked about the butterfly, how it works. I should have showed you this earlier. Sell 2 at the money strike calls, buy one lower, which is 25, and then buy one, which is 29. So those two, so 25 and 27, these red, close to those red, these where it becomes flattened, those are the ones you will buy, and then you let it run in between, because that's where you would start making money. And in the Condor, in a Condor, what you would do is you would actually set. So you'll say that between 26 and 28, I am the winner, and I'm truly the winner. And if it goes below a certain 24 and 30, then I lose a little bit. So it's a risk reward ratio. You ask me, I think Condor is better than Butterfly because it's a flatter trajectory here. So you have some area where you can count on making some money. So I leave it to you guys to ask any questions at this point because we are about an hour. So any thoughts there?
Hey, this is Muhammad Talal. So my first question is all the strategies that we learned, how many of them requires you to have 100 shares before going into the option trade?
No, you don't have to have 100 shares at all. Those are just for protective put and covered calls. Because guess what? What will happen is that brokerage will not let you sell or buy an option against a stock which is not at least 100 shares. Because an option is written on 100 shares. So you cannot say hold 70 shares of Tesla and write one call option, because one call option gives exposure on 100 shares. So they want it to be equal. Other than protective put and covered call that we discussed, everything you could do without anything over 100. 100 is just a standard notation that one contract is 100 shares, but it does not have to do anything with 100. The word 100 is just a magical, which you multiply with every number that is seen here. You just multiply by 100 because one contract means 100. So you multiply. If you buy, let me give you an order. So if you do an order here, see, if I do 10 here, that basically means that my price would be, what did I do? Oh, I'm buying the 26 call 10 contract. So yeah, so when I try to place this order, it will ask me. So let me send. It will give me an error, but yeah, see, it gives you 1716 because it multiplied 1.71 with 1000 because 10 contracts, right? If I do 5 contracts, let's see what happens. Or so the way it will work is you have 7 contracts, means 700 shares times 1.71, and that's exactly what it will be. So I can give you calculation. So it will be 700 shares times 1.71 roughly would be about the same number. So that's how they come 1197 right here. So there's nothing that stops you from having 100 shares of anything other than if I go and I select a covered call here or a caller. Callers are about the same thing, right? So if I do covered stock, then it will not let me hold 50 or 30 share of something and sell one call option or do something with the call, because it assumes that you hold at least 100 shares or a multiple of that. Like if you have 145 shares of something, it will let you write one call, because 100 you have and 45 it will not let you write anything. That makes sense?
Yeah. So I got it. So
yeah, you can buy any calls or any puts as you see. There's nothing on that, but your exposure will be on 100 shares. You always multiply it by 100.
That I agree. I was just wasn't sure that because in the covered call you need to have 100 shares
at least
on site before you go into that.
Perfectly right. Yes.
Yeah. So apart from that, you don't need 100 share.
No, you don't have to have any stock in your like I can have 100 shares of NEO, right? And I can keep trading options, or if I don't have 100 shares, I don't have to have it. I just simply buy and sell.
Got it. Yeah. My next question is when you say like if I have a sell call, the one, for example, the one you told us where it was the credit was 62, when you say you sell it, I mean you don't sell it, you let it expire and you still get $62.
Yes, precisely. You let it run. This one, right?
You don't do anything. Okay.
You don't. That's the money. Then they will put back that 138 in your account. Okay. So guess what they did? They put a hold of that 138, but then they will give it back to you because you are the winner. You get 62 and go home. That's your money to keep.
Okay. And same that means.
I think you got. Okay. I don't know. Okay.
Sorry, Mohammed, can you ask the question again? Mohammed Khan?
I think it's Talal, is it? Or
who was asking question? I think Mohammed Khan was.
I think we got distracted, but that's okay. Any other questions that you may have on this? I mean, I know it's a lot to absorb in just a small amount of time. I mean, you have to play with them. My goal was to just give you an intuition of how these spreads work. But we're gonna dive deeper into calendars next time first up, and then we will do some trades. Actually, we will do some trades where you could actually use calendars or write options against stocks, and how you can make use of time decay. That's the most important portion in my view. So yeah, if you don't have any more questions, like sure.
Yeah, so I have a question. What do you think is the best play for earnings?
So if you ask me, I generally sell straddles on that, and that's here's the thing. Market price is those based on some understanding, right? Market will say if Apple is gonna, what did you say, Apple 5%? You know what? If you ask me, I will basically bet against. I will say, you know what? You take 20, you take 5%. I'll give you that option. Why don't you take it? I'll hedge myself and I'll see if it actually moves 5%. And if it moves, worst case, gonna move 7%, maybe I'm okay to take 2% loss. But I generally am not too big of a fan of straddles. But people, I mean, if you really are right, I mean, you make money very quickly and direction like Netflix. If you know there's gonna, when is Tesla's earning? Tesla is gonna move like 10%. Does anybody know when Tesla's earnings are out? We can check it right here.
Tesla was last week. Tesla already.
Oh, it already happened. Okay, yeah. Sorry, I didn't follow it. Yeah, I mean, Microsoft, you can look at Microsoft. Or, yeah. This is good. You straddle check it.
Facebook is also coming up next week.
Oh, nice. Let's see. Facebook will be interesting, more interesting than it probably be 5-6%. It's not like one of those that are like 12-13%. I mean, hold on. Let me. So in my watch list, yeah, this is already done. Neo, Micron, Gilead. Actually, Gilead is very boring. So I don't know. I think let's look at Facebook quickly. We can just spend a few minutes here. So Facebook is trading at 284, right? And you said it's this week, right? So 284. So let's take 285 straddle. 285 straddle. Let's look at the straddle. So 285 straddle is about 21, right? So 21 divided by what was that price for that? 281 was it?
284.
285 almost, yeah. 285. Yeah, 7.5%. So they think now. Then I would rather sell it. I don't think it is gonna move. It's probably gonna be 4 or 5%. And but what if it moves 20%? Then I'm the loser.
Right.
There are ways you could. I mean, look at the last maybe 10 earning cycles and see if it is. I mean, that's what they look also. So it's hard to outsmart the market. I mean, they have better algorithms than you and me to figure out. But I think if market is pricing at 7.5%, if they underprice it, everybody's gonna hold that call, like the straddle. If they overprice it, everybody's gonna sell that. So that's the optimal. There should be a research paper somewhere you can find like how many times these straddles are actually underperforming or outperforming, because you can actually, the 7.5% is what Facebook they think. Generally sometimes they disappoint. They're just like flat. They will go in one direction and then they will lose back and kind of settle down at 2 or 3% move. So that happens a lot. So it's really up to you. You wanna sometimes long them, the straddles. I would say strangle is better, because in the strangle, what you can actually do is you can. So who asked the question? Are you bullish on it? So I'll do a strangle. I'll say if you are bullish on Facebook that will hit 300, what I'll do is I'll do something like this. I'll say not 10. That's a lot of money. So buy 130 to 85 call, and then just in case it drops, let's buy a 270 put. Now you're talking, right? So your $1,500 right there, And if it goes to 300, you make up, at least you make up the 1500, right? You're following me, right? So upside break even is 300, right? So that then makes it better deal, right? Because 300, that's a $15 move on top of 285, right? So that now is not a big, that's 5% move, right? But then you are counting on it being more bullish, because you cut it down a little bit because you didn't buy, you strangled it. So you said that I'm not taking a bet which was this, a symmetric bet. I'm not taking a straddle, because this is practically a straddle right now, right there. So in a straddle you have to move 7.5%, but in a strangle you have to move only 5%. So you have to give yourself a little bit chance, is what I'm trying to say. If you are truly wrong, then that put option hopefully will defend something, give you something back.
You will not lose everything, like in the call
option.
I mean,
you lose 1500 versus, well, you can still lose if it's 280. Then you lose everything, right?
Yeah.
That's the problem with the strangle, is because strangle. Yeah, there's a little bit of a portion. This is, in your case, is 270 and 285 in your case. There is a little, but then you lose $1,500, but that's the bet you prefer to play. I mean, Facebook, $1,500 bet you wanna, but guess what? If it moves 10%, you make money, right? 10% is $28, $30 move. That's 315, right? So in the 315 case, minus 285, 30 times 100 shares, 3,000 or 1,500 investment. Question is, do you count yourself to that it will move $30, which is almost 10%? But that's what you have to. If I was you, I would not play straddles. I would probably play strangles more and give myself a little bit chance, because I'm at least I know something. If now that's a different story, that if you're wrong most of the time, but that's generally why I think that the pure straddle is when you are truly not sure what it will do. It's a completely delta neutral strategy in its true sense.
Understood, sir. Thank you.
Right. I think so. We are an hour 15.
All right.
Mukarram also shared his Excel sheet. If somebody asked, requested, and he shared. Anybody else interested, they can send directly an email to Mukarram, and he can share his Excel sheet with you guys.
Yeah, anytime. Just text me your email address and I'll shoot it to you.
All right. So next Sunday, inshallah, we will have our 5th, and maybe there is another one, but for now, 5th.
Yeah, I mean, yeah, let's at least go through calendars and some data. I mean, this time decay, some of these things that I've learned over the time, and I like those. Obviously you can play long calls, long puts if that makes more sense to you, but we'll complete the whole basic session and then go from there. You can find best strategies for yourself, what works best for you.
All right, have a nice rest of the evening and see you next Sunday, inshallah.
Thank you very much. Thank you. Assalamu alaikum, everybody.